Good evening everyone. Welcome to Trading Hour. Today we'll discuss what bullish candlestick patterns are. But before that, let's see what candlestick charts are. Candlestick charts are created to help traders better understand price action. Price action allows traders to know whether the market will go up, down or trade sideways. And one of the easiest ways to gauge this market momentum is through different candlestick patterns. Depending on the type of bullish candles formed, it gives traders confidence that how the market will take its course in coming days. Now let's understand what candles are. The color of the central rectangle of the candle tells trader the open and close prices, while the candle wicks signify the high and low. A bearish candle means the closing price was lower than the opening price, hence it shows selling pressure and the movement is also bearish. On the contrary, the red or green candles mean the closing price is higher than the opening price and it displays strong buying pressure and the movement is bullish. Now, a candlestick pattern is a particular placement of two or more candlesticks on the chart that indicates a breakout or a sustained move to the upside. These candlesticks are used as a self-sustained signal to enter a long position along with other technical signals. For example, if you witness a bullish candlestick pattern generating after some time of consolidation, it might indicate that the stock is about to come out of the consolidation. And if a bullish candlestick pattern forms at the significant support level, it may indicate that market is about to turn around and head north. If you dig out the list, many candlestick patterns will pop up with different characteristics. You don't have to follow all the candlestick patterns, but there are 6-7 candlestick patterns that are very popular among traders and investors. I also use it very often for my trades. Now let's understand the first candlestick pattern, that is hammer. The hammer pattern is bullish and appears at the bottom of the downtrend. This kind of pattern occurs when the low and open prices are almost similar. The hammer pattern consists of a lower wick which has double length as compared to the original body. That indicate the seller, which shows the seller is driving the price lower, but buyers are showing interest to buy at the current level during the trading session. While identifying the hammer pattern, keep in mind that the previous trend should be a downtrend and the appearance of hammer should be backed by rising trend in the trading volume also. Let's here consider the example of Bharat Forge. Now, instantly after opening low, Bharat Forge got through the low from pre-market due to buying interest by traders. And when it was approaching the higher levels, the trade volume was also increasing. So that kind of confirms the reversal in the stock and we can take a long trade here. Now the second one is the bullish engulfing pattern and its counterpart is called bearish engulfing pattern. The bullish engulfing pattern appears more often on the chart and has a good record of a positive role in the bullish direction. This comprises of two candle lines. The candle number 1 is generally a small bearish black candle or a red candle and the other one is a larger white or a green candle here. The second candle in a bullish engulfing pattern formed with a bit of space, but then stock trades up with volume and ends much above the previous candle's initial price. Now let's understand this with an example. SBI, here you can see the smaller red body that represents the selling power was completely covered by the second larger green body that represents the buying power. The color of the bodies is not important. What is important is that the smaller one should totally be engulfed by the second candlestick. That means larger green candle may fully engulf the previous smaller green candle or the smaller red candle. This candlestick pattern, if occurs after a downtrend, then have higher importance and indicate that stock is no more in the grip of sellers and buyers will take control of this stock going forward. Now the another candlestick pattern is the tweezer bottom pattern. The tweezer bottom is another well-known and often spotted bullish candlestick, often considered as bullish candlestick pattern. This pattern has two candles with minimal size body. The first candle is supposed to be red and the other one needs to appear in green color or should be a bullish candle. The candles are generally quite close regarding their opening and closing price. This produces a visual of the pair of tweezers. In terms of meaning, the tweezer bottom indicate the fact that the value is striving to get down but to no avail. Tweezers are quite popular with traders searching for clues for when the market is going to reverse. The reversal in case of tweezer offer a great risk reward, and earlier you get in on the trade here, the higher the reward is. Now in case of Tata Motor here, it beautifully displays the movement of price fluctuation after the appearance of this candle. Pay close attention here in this case to the two candles, their symmetry and the closing and the opening of red and green bars. The bullish candlestick pattern is a beneficial means of recognizing the opportunity for high value trade. However, investors and traders confuse when it comes to identifying the pattern in real time. You can only achieve the skills with practice. Now, since you have learned 3 candlestick patterns, please practice it at your end before I teach another 3-4 candlestick patterns next week. Thank you.